Holding steady, up 0.7% on the Nifty and the Sensex. Nifty above 19,550, a 100-point plus gain. It's been a good morning so far. Banks are performing today. The Nifty banking index is up 400 points. We have with us Santanu Chakrabarti of BNP Paribas to talk more about the banking sector and where we are headed just ahead of the earnings season. Mr. Chakrabarti, thank you very much for joining in. First, what would be your top takeaways from the various updates, the business updates that we've got so far on the banking side and then even on the NBFC side?
Yeah, thank you for the opportunity. Banks, the updates which have so far come out show a few clear trends. Firstly, credit growth is definitely not slowing down. What was visible in the overall aggregate numbers for the system is reflected in the banks like HDFC, IndusInd that have already come out with their updates, and even in the smaller banks like AU. And what is very interesting is the growth granularity that has been provided by the banks is also squaring with the data that was available at the system level, which is essentially that some of the SME and retail segments seem to be leading the growth, and large-scale industrials credit pickup is some time away. And that gives you some confidence about the longer-term 2-3 year credit horizon for India, because as we know, corporate leverage levels are at an all-time low. So that's still a leg of the engine which is yet to fire. And yet, despite that, we overall have fairly good numbers, and high teens to 20% kind of credit growth seems to be possible for a large variety of banks for the full year.
Okay, so that's trend number one. Any other trends that you've spotted?
See, firstly, term deposits, despite term deposit rates not having gone up too much for most banks in the last 3 to 4 months, still remain fairly robust. You must have seen the overall system growth number of 12.8%. Yes, to an extent, the demonetization of 2,000 rupee notes would have helped. But even without that, the deposit growth is slowly starting to inch up closer and closer to credit growth, which is the downstream impact that is to be expected. CASA growth, nevertheless, still remains fairly low. So this is entirely term deposit led. Part of it has been migration of some of the higher ticket yield seeking kind of savings account money towards term deposits due to better interest rates that are available. And that is something that is starting to play through. Now, one of the worries that the market has had about this trend is what does that mean for margins? We are now at a part of the cycle where the legacy term deposit book, given that most term deposit portfolios are 2 to 3 years in duration, on average duration, is not that much of a price differential from what the incremental rates are coming in at, especially when I put it in the context of the aggregate liabilities that a bank carries. So yes, can margins moderate a little bit from banks going forward? Possible, but we don't expect anything dramatic to happen on that front unless credit growth itself picks up through corporate loans in the second half of the year, which is not something we are building in as of right now. So those would be the key trends which are coming out from the quarterly early updates which have come in.
Shantanu, can you sort of put a number to that? This NIM compression, that is this big fear on the street, at an aggregate level, say Q2, how much compression are you penciling in your estimates?
So, for most, we have penciled in something like 5 to 10 basis points for the quarter, and about 10 to 15 basis points for the full year, which is, as you can understand, is not very dramatic. Now, there are a couple of exceptions where the NIMs are a little more resilient. Say, case in point would be, say, something like IndusInd, where net interest margins are more resilient because some of their higher yield segments are growing at a fairly fast clip. And they are not coming off a very highly optimized liability base either. So incremental cost of funds delta, if you would say, is not as dramatic as some of the better liability franchises out there. So as a combination of that, you'd see probably margins more resilient in slightly NBFC adjacent kind of banking names. But overall also, I mean, even for the top banks, the 10 to 15 basis points, as I said earlier, is not as dramatic.
Okay. Not as bad as what the market was perhaps fearing in terms of a NIMS compression. Shantanu, your report goes on to say the risk-reward profile remains exceptionally attractive. Do you want to talk a little bit more on that?
Sure. So, something that's been highlighted quite often for the banking sector in India today is if I look at the markers of balance sheet health, whether it's in terms of how much real equity banks carry, how much provisioning they have against what current stressed assets are, and the emerging situation of stress itself. Probably these are the healthiest balance sheets from a credit risk perspective that banks have had in a very long time. The only comparable period might be 2003, but please remember, even at that time, the disclosure standards and recognition norms were not as tight as they are today. So despite that, the numbers are where they are. And if you look at any high-frequency data in terms of segment-wise data, in terms of how asset quality is moving on an extent basis, there's not too much pressure. So that's a big comfort point that we have. On top of that, we have credit growth running at a fast clip, despite corporate loans not contributing too much. Retail and SME as of now is doing the heavy lifting. As and when, the corporate leg also picks up, the growth can go up much further. And finally, the only impediment to growth that people were pointing out, which even at that moment looked a little myopic to us, is that, the supply side concerns of liquidity levels of banks constraining growth itself. Now, with deposit growth also picking up, that's a harder argument to make. As I discussed earlier, margins, it might moderate a little bit, but that's nothing really to write home about. Credit costs still remain low because of the first point I made. And even if you don't get too much of operating economies because banks will continue to invest, ROEs and earnings growth looks fantastic. So overall, this is perhaps the best fundamentals the banking sector has shown in close to 2 decades. Against that, if you look at banking sector valuations, we have something like HDFC, which on a core basis is today trading at 2.2, 2.3 times 1 year forward, if you strip out the subsidiary valuations. That's like almost a 40% discount to its average trading value. And when we see that there the ROEs are going to touch, say, 17% 18 months out, which is pretty much the ROE they used to earn in the 5-7 years preceding merger, then it's very hard to rationalize that multiple. ICICI Bank similarly give...
sorry, please continue.
Yeah, so I was saying similarly in ICICI Bank also, given the extent of cleanup that has happened, there is still some re-rating potential. In Axis also, you'll see the same. In most names, it is at or below median levels. So you have best-in-class fundamentals in terms of the last 2 decades, and you have valuations which are at or below median. That's the definition of good risk-reward.
I see your top picks, Shantanu. Most of them are private sector names, HDFC Bank, ICICI, Axis. I think even SBI makes it to your list. Nothing beyond SBI on the PSU side, not convinced with this mega PSU bank rally?
See, I think when we look at the PSU bank rally, we have to keep things in context of a slightly longer horizon. The rally is coming off a low base, and the rally is on essentially the hope, and very similar to the 2003-04 rally, of a reconstitution of equity of these businesses. Now, some of these businesses, if I look at a decadal track record, there has been chronic issues beyond what you see as acute problems to the levels of capitalization of these balance sheets. I understand that there is a privatization story going on here, if not directly, but then through an indirect method. Their balance sheet health has obviously improved. But, I think investors need to be overall quite cautious about what they buy within that basket because, if the enthusiasm reduces, if rates surprise on the upside due to external factors, etc., any risk of, I expect higher beta names to be impacted a lot more.
No, fair enough. I think that's a point well taken. The kind of huge run-up we've had in these mid-cap PSU banks, perhaps some caution is warranted. Thank you very much for joining in, Shantanu. Good chatting with you today. Need to slip into a very quick break, but as we promised, today is really all about banks, banking, the bond market, and